Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, do you know what are balanced advantage funds? How do they handle market volatility? And why are they gaining popularity of late? Do you know which one can help you navigate the volatile equity markets for maximum benefit? Well, watch today's episode. We'll tell you all about them and also help you decide if you should invest in them. Stay tuned.
Balanced advantage funds are gaining popularity because the storyline is very compelling. Here is a fund which will not fall as much or will not fall dramatically if the market falls and will be able to rise reasonably. And here the promise is that the fund manager will do magic. He will be substantially invested in equity when the markets go down, and he will be able to get out of equity when markets go up dramatically or when he thinks that market has become expensive. So this looks like a dream product, and this storyline has worked very nicely with it has been able to strike a chord with investors very well, and that is why investors have poured nearly 1 lakh crore into these funds more in the last 3 years. It has gone up from 1 lakh, nearly 1 lakh to 2 lakh crore in 3 years, which is quite a substantial surge because these funds are bought by individual investors only. I don't think institutional investors, companies invest in them. Also, unlike the index funds where some institutional investors are pouring a lot of money month after month simply because they find it convenient, there is no compulsion. Here is a fund where investors are making a choice based on their understanding, making a choice based on the pitch that they hear. And here the pitch is very compelling, that we will help you ride the market, and we will not only help you ride the market well, we will also help you avoid the big falls, the big declines in the market as and when it falls. So this strikes a chord, but I'm really wary that is it really working? To understand balanced advantage fund, let me explain you the history or the genesis or the evolution of balanced funds in India. First, we had balanced funds which were really balanced, 50% into equity and 50% into debt. Then the tax laws changed, and the tax laws were different for equity and different for debt. For equity, it became tax-free. If you hold it for 1 year, it became tax-free. But equity funds were defined as something which will invest 65% and more in equity. Any fund which invests 65% and more in equity will be treated as equity fund. So most balanced fund actually became unbalanced. They've moved their equity allocation to 65%, and they call themselves balanced fund, but they were 65% equity, 35% debt at the least, simply to qualify as a preferential tax, because all the gains became tax free. So it was a very tax efficient vehicle. Then what happened was markets went down post 2008, and there were investors who were wanting that let there be a balanced fund, let there be a 50% equity, 50% debt. And what happened was most fund companies devised a new trick that we will create a balanced fund which will remain balanced, but from the taxation point of view, it will not be treated as a debt fund. So what they did was they created a fund which will be 35% into fixed income, 35% into equity, and remaining, or maybe 50% into equity or 48% into equity. Remaining in equity derivatives, the character of those equity derivatives will be such that it will, the character will be that of fixed income, but they will be, from a taxation point of view, they will be treated as equity. So it was great, it was a more stable vehicle, it was a balanced fund, it was getting taxed preferentially as an equity fund. So that was nice. Then this whole SEBI classification came into being, and that is when SEBI was getting very uncomfortable that and most of the older balanced funds, which were aggressive hybrid funds, they were 75% into equity, 25% into debt, reasonably equity. I would call them almost like an equity fund. So SEBI was very uncomfortable that these funds should not be called balanced because they are not balanced. So the shift from balanced fund gradually to being almost like a quasi-equity fund forced fund companies to create a balanced advantage fund, which from a taxation point of view was a balanced fund. So now we have many kind of hybrid funds available. We have funds which are with frozen allocation. The aggressive hybrid fund are 75% equity, 25% debt. Then we have this balanced advantage fund. Then we have this conservative hybrid fund, which is nominally into equity, substantially into fixed income, which is 25% maximum equity, 75% debt, and they are frozen allocation. Whenever this 25% is tending to cross that thing, fund manager realigns, rebalances it. So there is a great advantage of this rebalancing when it happens within a fund. If I do these rebalancing myself, if I invest of my 100 rupee, if I invest 75 rupee into equity, 25 rupee into a debt fund, and my debt fund actually becomes 30%, which means equity has gone down, I will sell some and I will buy something else. It will create all kind of tax incidents. When it happens within a fund, it is not a taxable situation. It is not a taxable event. The fund manager is doing it, and you will be taxed based on your holding period. If you hold it for 3 years, if you hold it for 1 year, accordingly it will be taxed. This gets you the advantage. So all these hybrids actually give investors an advantage of not bothering about the rebalancing, even frequent rebalancing. Because if we do very frequent rebalancing ourselves in our own account, it will all be taxable, and we will have to worry about all the short-term capital gains, long-term capital gains, so on and so forth. And so this balanced advantage fund got created, and the storyline was perfect, that here is a fund which will try to benefit. You can ride with the bulls, and you can also benefit from the bear phase of the declining phase of the market. Looking at the averages, the balanced advantage funds have been able to put up a reasonable case for themselves. They look better than equity fund or the Sensex when I'm just comparing it with the benchmark. Compared to that, they fall less, and that is the promise, that they should be able to do reasonably okay when in a rising phase of the market, and they should fall less in a falling phase of the market, and that looks like a reasonably attractive proposition for most investors, and that they have been able to achieve. But when I compare them against aggressive hybrid fund, a fund which is 75% into equity and 25% into fixed income, those funds have been able to do this far more successfully. Now we have more than 10 years of history of these balanced advantage fund, and much longer history of the older balanced fund, which are now aggressive hybrid funds, or now called aggressive hybrid funds. And those funds are able to withstand the declining phase of the market much better, and they are also able to participate in the rising phase much better. And balanced advantage fund, despite their mandate that they have far greater flexibility. The fund manager can reduce his equity exposure to 35-40%, or he can increase his equity exposure to 60-75%. So he has far greater flexibility. But it has not worked out very nicely for investors compared to they have put up a reasonable case, but I don't think they have put up at least in the averages, it does not present a very compelling case. The aggressive hybrid funds, because despite their frozen allocation, that they will be 75% into equity, 25% into debt at all times, that is presenting a much stronger case on the downside as well as the rising phase of the market. First time investor wanting to invest in equity should consider these balanced advantage fund or aggressive hybrid fund, simply because all the good stories or the long term return potential of equity fund is fine, but when we are faced with 10,000 rupee invested 5 months ago, 10,000 rupee invested 4 months ago, and the accumulation of 40-50,000 rupee going down by 40% is something which for a new investor is very difficult to reconcile. So to fall in habit of getting used to the perils of equity or the madness of equity market and the potential of equity market, one needs a steadier vehicle, and these funds actually present a very strong case that they don't fall dramatically, and that is a big comfort for any new investor. Only after you have invested for 2-3 years that you get used to it, and then you realize that okay, this is the nature of the beast. Here is something where you get more return, but there is a price, The price is stomach ache. You have to withstand that. And that is something which one should be, it helps you acclimatize yourself to the market. So consider these. And of the two, when I look at the balanced advantage fund, and now because we have a long-term history, now we have over 10 years of performance track record of balanced advantage, as well as even longer history of the balanced funds or the aggressive hybrid funds, what was erstwhile balanced fund. I think the case for aggressive hybrid funds is much stronger. The frozen allocation of 75% or the disciplined allocation and rebalancing of an aggressive hybrid fund is presenting a stronger case on both front, in terms of the declining phase of the market. When the market fall, they fall less, and 10-year time period, they have been able to generate superior returns too.
That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.